Everyone says refinancing your student loans is the smartest way to save money. But what if this brilliant move came with a penalty that lenders don't advertise? A penalty that can knock down your credit score. You refinance, get a fantastic new rate, and feel great about your finances. Then you get a credit alert. Your score dropped. You made a responsible choice, so what gives? Let's get into the real story. First, the most immediate reason your score dips is the hard inquiry. When you apply to refinance, the new lender runs a full background check on your credit report. This formal request tells credit bureaus you're actively looking for new credit. Think of it like a potential employer calling your references. 1 or 2 calls are normal, but many can look desperate. For most people, a single hard inquiry will only ding your score by 5 points or less, and the effect fades in a few months. And if you're wondering whether a hard inquiry actually hit your report, this is where checking your credit really helps. I use a credit monitoring service that shows your FICO score, full report, and sends instant alerts for things like inquiries. It only takes a few minutes, and it's almost free. Links in the description if you want to check yours. The second reason feels a little backward. When you refinance, your new loan pays off your old ones. While that's great for your debt, you've just closed one of your oldest credit accounts. About 15% of your credit score is based on the length of your credit history, the average age of your accounts. Closing a loan you've paid on for years lowers that average age. This can make your credit profile look younger and slightly riskier, causing a temporary dip. Finally, the third hit comes from opening the brand new loan. This new account has 0 payment history, making it a total unknown to the credit bureaus. The new credit category makes up about 10% of your FICO score, so adding a big new loan can temporarily signal instability. It's not until you start making consistent, on-time payments that this new account actually begins to help your score. So, does this mean refinancing is a bad idea? Absolutely not. The credit score dip is almost always temporary. Within a few months of making steady, on-time payments, your score will usually bounce back and often climb even higher. That's because your payment history is the single most important factor, making up 35% of your score. The trick is to be strategic. Pre-qualify with multiple lenders first, since those are soft inquiries that don't hurt your score. Then, submit all your official applications within a 14 to 45-day window. Credit bureaus usually count multiple inquiries for the same type of loan as a single event when they're grouped together. The real reason your score drops isn't that you messed up. It's just the system reacting to a hard inquiry, a closed account, and a new loan. But now you know the drop is small, temporary, and manageable. You can refinance with confidence, knowing you're playing the long game to build a stronger financial future. Have you refinanced and watched your score dip? Share what happened in the comments. Your story could help someone else.